I will give him 2 more minutes. If we don't hear from him, he'll be Shawnee flying solo. What's happening, everybody? It's your boy, Chicago Sean McLaughlin. I'm the Chief Options Strategist at All Star Charts. This is the Options Trade of the Week. Usually, JC joins me on these calls, but our good friend JC is minutes, perhaps seconds away from becoming a father of 2 twin boys. So he's kind of in that whole flux right now, heading to the hospital in the waiting mode. It could happen at any moment. So we're gonna fly without him today. And JC, I know you're watching. Good luck, buddy. Everything's gonna be great. I'm gonna send you a couple Bills onesies for your babies there, because I know they're gonna grow up to be Buffalo Bills fans. So look for that in the mail. Anyway, let's get to our trade of the week today. So JC was around this morning, and we had our weekly analyst call, me, JC, Straza, and the team, and we were kicking around ideas of what looked good and what we wanted to trade. And one thing that we were talking about is that all the best setups, whether they're bearish setups or bullish setups, all the charts that looked like the best setups to us, unfortunately, those companies were reporting earnings in the next week or so. And I don't know about you guys, but I don't like putting on positions when we've got an earnings event, a binary risk event coming up within a week or two. The last thing I want to do is just get on the wrong side of a face ripper in the wrong direction because of something that the market didn't expect coming out of an earnings event. I don't like binary risk like that. I know there's a whole cottage industry of people who like to sell options premium ahead of earnings events. If that works for you, great. For me, it doesn't allow me to sleep very well at night. So I tend to stay away from that. However, we were observing that when it comes to big banks and the money center banks and some financials, a lot of them have already announced earnings. There's still a few more on deck, but a lot of the big ones, your Morgan Stanley, your Goldman Sachs, places like that, have already gotten earnings out of the way. So gap risk in the banks seems to be mitigated somewhat, but we could further mitigate that risk by playing in ETFs. So I got a chart here of the S&P Banks ETF, ticker KBE. Now, there's a couple things you'll notice on this chart. Number one, it's very easy to notice what appears to be a topping pattern. So we don't want to be bullish on a chart that's got a topping pattern, do we? Well, hold the phone here. One thing that also stands out, and JC's been harping on this a lot lately, he was on Fox Business last week with Maria Bartiromo talking about this, is that there's a lot of stocks and a lot of sectors that are still hanging above their June lows right here. That is not bearish. Now, does this mean a setup like this, we want to get aggressively bullish? No, we're not aggressively bullish here. But as long as these levels hold, we think there's reason to be optimistic that at least the lows, short-term lows, may be in. And because of the market environment we're in, with VIX still hanging above 30 regularly, there's still lots of premium out there for options traders to sell premium and have put on some bets that have high probability of success. So what we are doing with KBE is, you see I've got the 44 level highlighted here on the chart. That's the low that we've seen in the last few weeks. We can sell December 44 strike puts in KBE and get, well, we put it on for $1.15 this morning. You can get a little bit more for it. Last I checked, I think you might be able to get $1.25, maybe $1.30 for those puts. And the bet that we're making here is that level of 44 is going to hold at least for the next several weeks. And I got a P&L graph here to show you here, and bear with me as I pull it up. But we'll get this going here for you real nice. There you go. So here's what the P&L graph of this chart looks like, or this trade. We're selling the 44 puts in December. December has, I think, last I checked, 58 days until expiration. So just starting to get into our sweet spot of where we want to be short premium. Got some time to let this thing work, but our risk management on this trade is really quite simple. If KBE cannot hold above 44, which corresponds with that level of the recent lows, if we see any close below 44, we're going to pull the plug and get out of this trade, win or lose. Now, it might be a winner depending on the timing of when that level is broken. The closer we are to December expiration, the more likely that we might still have a profitable situation in our hands here. But more often, or more likely, we'll be losing money if we're below 44. Hopefully not too bad. It should be pretty manageable. But this is a undefined risk trade, right? The stock can go to zero and we could lose the entire way. We don't want that to happen, of course. It's unlikely that an ETF is going to go to zero on our watch. But anyway, below 44, we're going to close the trade down, win or lose, to manage our risk because we have undefined risk. On the flip side, as long as KBE stays above 44, and I like our odds of that, I like our chances of that, then we're going to leave a resting order to buy these puts back for half of what we collected today. So we collected $1.15. So I've got a resting order to buy these back at 55 cents. Good till canceled, meaning that's just going to sit out there and work. I don't need to pay attention to it. When the market trades there, if it trades there, my limit order will get hit. I'll get taken out of my trade. I'll book the profit and I'll move on to the next trade. My best practice is I like to cover these things when I've earned half of the premium. I don't want to keep holding that risk, sweating that last nickel and dime. And lo and behold, ladies and gentlemen, back from the car, he turned the car around. Another false alarm on the hospital. JC Parets is in the house. JC, there you are.
What's up, my man? Yeah, just staying ready. Staying ready. That's it. No big deal. You've been through this. It's a little shaky, tough to keep a calendar.
I love that you're popping in here, ladies and gentlemen. We do this live, obviously, and there's no script, and we just play along, and we roll with the punches, and we thought JC was in the car, speeding, breaking every speed limit laws in northeastern Pennsylvania, but no, here he is.
No, here we are, selling naked puts, because we just haven't sold enough of them. Am I right?
Well, look, it keeps working. We finally got out of our Berkshire trade. I finally got out of my Berkshire trade yesterday that you and I put on about 3 weeks ago. You got out earlier than me because you had a better entry price to me because you're fancy like that.
No, it's just because I didn't wait till the end of the meeting to put it on. I put it on right away.
You had no patience, and it cost me an extra $1 in entry price. But hey, we're both out. We both made our profit. That's the good news. But yeah, we've been selling a lot of puts lately. Because it's working. And yeah. I was talking before you jumped in about how, hey man, there's a lot of stocks and a lot of sectors that are still hanging above the June lows. And while that doesn't necessarily make us aggressively bullish, it's certainly something we want to pay attention to and might be levels we can lean against to at least make some money in a sideways tape.
Well, yeah, there's a big difference between being bullish and being not bearish, right? There's a difference between that. And essentially, by selling puts, isn't that what we're doing? We're being not bearish. Like, yeah, we've got some positions that are bullish and energy stocks and some industrials and some financials. And sure, there are stocks that we could be bullish on, but there are definitely a lot more stocks to be not bearish on, right? There's a difference. That's how I look at it.
Right. And as you can see from my P&L graph here, the KBE's trading, at least at the time I took this photo, is trading right around $47. I mean, this thing could trade down to 44.5 and we still can make money on this trade. So we don't need it to go up. We just need it to not break the recent lows from the last few weeks, which was right around $44 a share. Well, listen, JC,
I actually didn't think that this was going to be liquid enough when we were talking about it in our meeting. I'm like, no shot that trades options liquid enough. And Sean's like, and I even said, I was like, listen, I'd be happy to be wrong on this one, but I don't think I am. And sure enough, I was wrong. It is liquid enough. That's not, by the way, that's not the first time that this happens. I've been wrong on the liquidity aspects of the options market on a couple of ETFs recently. Happily wrong, by the way. So don't let, old volumes keep you away. Make sure to check the volumes because if we didn't, I would have probably made that mistake a couple of times. And Sean's the first one in there being like, I think it's all right.
Well, I'm glad you brought that up because this is a good lesson for people, especially if you're new to options trading. when you're considering putting a trade on and considering the liquidity in the options, which liquidity is important, right? You don't want to get stuck in a position you can't get out of, especially one like this where you're naked short options. But there's two things to consider. Most people just look at the open interest and the volume of contracts traded on that day. And nothing wrong with that. That's a very viable thing. But the other thing you might want to consider is, are the bid-ask spreads tight? Is a call, let's say, bid 50 cents, offered 55? Is it bid $1, offered $1.10? If you have those in the options world, that's considered a tight spread. If you have those tight spreads, even if there's no volume today, or even if the open interest is low, that tells you that there are market makers who are willing buyers and willing sellers of that contract. So that is another way to say, oh, well, there is liquidity here. There is somebody willing to take the other side of the trade. So that's kind of the mental gymnastics I did in my head, JC, when we were looking at these options today. There was some volume and there was some open interest. Neither are overwhelming, but the bid-ask spreads were tight, and that was, okay, good enough for me.
And keep in mind, again, it changes over time. So just because maybe a few years ago, you weren't able to trade options in something doesn't mean that you can't now, and vice versa. So, that was a mistake that, I almost made a couple of times if we hadn't looked. So a couple of great lessons here. Glad I was able to pop in, bring something to the table.
Hey, it's nice when you can surprise us. You got some surprises in store for yourself in the next 24 to 72 hours, I'm sure. But hey, man, we're all pulling for you. Good luck with the kids. I got a couple of Bills onesies on the way for you. You're going to be all set.
Oh, are they good at starting fires? Is that what they're for? Is that what you're selling them?
Or breaking tables, either one. That's fine.
All right. Well, thanks for letting me pop into the Sean show.
All right. Well, hey, happy to have you, buddy. Always great to see you. Take care, everybody. Good trading out there. We'll talk to you next time.
Sell them naked. Sell them all naked.